We're all here?
Yeah.
We're not waiting for anybody else?
No, we got both here, I believe.
All right, we'll call to order this Finance and Investment Committee meeting at Vallecitos Water District, Monday, November 3rd, 2025 at 3:30, right on time, as always. Notice to the public, persons wishing to address a matter not on the agenda may be heard at this time. However, no action will be taken until the matter is placed on a future agenda in accordance with the board policy. Public comments are limited to 3 minutes. Request to speak form is required to be submitted to the board secretary prior to the start of the meeting if possible. Public comment should start by stating name, address, and topic, or it's not permitted during this time to enter into a dialogue with the speaker. Any public comment?
No, sir.
None here. Items for discussion. Number 1, fiscal year 24-25 audit results.
Yeah, for both these items, I'm gonna hand it over to Wes, our CFO, and I'm sure Wes will hand it over to the appropriate person. So Wes wants to take the first one.
Good afternoon. 2 items on the agenda today. The first is going to be the fiscal year 2024-25 audit results. We recently had our fieldwork completed in September, and we're working on the draft of financials, which should be brought to the board in November, for November 19th. And the auditors are here to talk about what happened and the results of the audit. So with that, I'll pass it over to Coley, our auditor within the group.
I think.
Welcome, Coley.
All right, let me share my screen here. All right, you guys seeing the presentation?
Yes. Are.
All right. So I'm here to present just the results of the June 30, 2025 fiscal audit, and just have a short presentation for you here. We're going to discuss the scope of work, talk about some audit responsibilities, which are really kind of just required communications by generally accepted auditing standards. Go over our approach to the audit real quick, and then I will lay the audit status and results on you. So starting off with the scope of work. So we're basically, the only thing that we're tasked with doing for the district as far as deliverables is the audit of the basic financial statement. So there's no federal grant audit or component units or anything like that. So really just the district's financial statement. So within that financial statement, starting with the financial section, which starts with management's discussion and analysis, which is currently pending. The report is in draft form right now. It has been reviewed, I think, multiple times by both my side and the district side, but there are still a few pieces that we will be including into the report after this meeting. And one of those, the first one is management's discussion and analysis. So then from there you go. You got the statement of position, balance sheet, income statement, cash flows, right? Then we have the notes to the financial statements, which are audited as well. The required supplementary information is unaudited, and those are supplementary schedules that include information about the net pension liability and the OPEB liability, as well as contributions that have been made. Those type of schedules. They are 10-year schedules that 10 years exist in the pension schedules, but the OPEB schedules are filling out to 10 years. So they'll be filled out in a few years. But those are also, as far as our audit opinion goes, those are unaudited, but we still do have responsibilities to make sure that those numbers tie to the audited pieces of the financial statement and that the numbers are accurate, but we do not provide an opinion on those. As far as then there is other information included in the financial statements that is unaudited as well, and that's going to be the introductory section, which includes the letter of transmittal and some org charts and things like that. GFOA certificate from the prior year as well. That section is also unaudited. And lastly, at the very back of the report will be the statistical section, which is unaudited as well, and we are still pending inclusion of that section in the draft at the moment. So we do issue within this document, we do issue two independent auditors reports. The first one is the report on the financial statements, which you would consider our opinion. We are issuing an unmodified opinion on that this year. And I do want to point out that there is an additional emphasis of a matter paragraph that is being included in the auditor's report this year, and that is related to a change in accounting principles. So the district implemented GASB statement number 101 this year, which is for compensated absences, Typically, when we do an implementation, it doesn't necessarily rise to the level of where we would put an emphasis of a matter paragraph in our auditor's report. However, this year, because implementation was retroactive, so back to July 1st, and 2 years were shown, there was a prior period adjustment to change the accounting principle back to July 1st, 2024. And since we're showing both 2 years comparative, we did adjust certain items, compensated absences, net position, salaries and benefits expense on the comparative statements to make them that they were still comparative year over year. So that's a piece that will be in there this year that will be removed next year. The second independent auditor's report is, we call it the Yellow Book report, or the Government Auditing Standards report. So that's the report on internal control over financial reporting and compliance. And that report is unmodified this year as well.
Coley,
Yeah.
can you remind the committee what unmodified means and what the other, I guess, terms as far as it wasn't unmodified?
What the alternatives would be towards yeah. So if you didn't receive, I mean, it sounds boring, right? Unmodified, right? But that's the best. That's the opinion that you want. That's the clean, the clean opinion. Alternatives to an unmodified opinion would be would be a modified opinion, which would be like a qualification, would be a modified opinion. That's basically where we're saying everything in this report except for something that is identified as being not in compliance with GAAP, or we didn't have, we had a scope limitation where we couldn't get information to support those numbers or something. That would be a qualified. We call that the except for opinion. So that basically means everything in this report except for this is good. So that's a qualified. The other one that would be a modified would be an adverse opinion, basically saying that these financial statements are not materially fairly stated in accordance with U.S. GAAP. So usually those ones don't get issued. Those situations get worked through before you get to that point, but that would be an adverse. And then the last option is a disclaimer of opinion, basically, where we basically just say there's not enough information here for us to provide an opinion on your financial statement. So you want unmodified, and that means that you have a clean opinion from us this year.
Thank you.
All right, so then I'll talk briefly about audit responsibilities, starting with management. Again, these are kind of just required communications. Management is responsible for the financial statements. These are management's financial statements. They're not our financial statements. They're responsible for presenting them in accordance with U.S. GAAP, and that they're materially fairly stated. They are responsible for adopting the accounting policies that surround the information that goes into those reports. They're also responsible for establishing and maintaining internal controls over the financial reporting, and for providing evidence supporting the amounts and disclosures in the financial statements to the auditors. All right, and then management is ultimately responsible for the fair presentation of the financial statements, and those need to be free of material misstatements, whether due to fraud or error. But lastly, management is also responsible for preventing and detecting fraud, and that kind of goes hand in hand with your establishment and maintenance of internal controls over your financial reporting. So on to the auditor's responsibilities. So our responsibilities, number one, is to provide an opinion about whether the financial statements are materially fairly stated in accordance with U.S. GAAP. We're also responsible for planning and performing the audit to obtain reasonable but not absolute assurance that the financial statements are free from material misstatements. And we're also required to consider internal control over the district's financial reporting. But we do have the disclaimer here that says those considerations are for the purpose of determining our audit procedures and our risk assessment, and we do not actually provide an opinion on the district's internal control over financial reporting. Few more for us on the auditor's responsibility side. We are responsible for exercising professional judgment and maintaining professional skepticism. So that means we don't just necessarily take whatever management or staff say for face value. That we are responsible for obtaining additional support and making sure that the things that are told to us make sense in line with everything else that we've seen throughout the audit. We are responsible for identifying and assessing the risk of material misstatement. Again, we don't provide an opinion on internal controls, but we do design and perform our audit procedures responsive to those risks, which would include examining on a test basis evidence regarding the amounts and disclosures in the financial statement. So again, internal control relevant to the audit. We design our audit procedures based off of those, but no opinion is expressed. We also evaluate the appropriateness of the accounting policies used and the reasonableness of significant estimates. And we do also compare those annually for comparability. And if any of these estimates or policies changed, we would evaluate why they changed and what the overall effect of that was. And as I mentioned, this year one did happen. It wasn't because the district changed their policy. It was because it was thrust upon them by GASB for how they're recording their the capital assets, or I'm sorry, the compensated absences. So again, we did do that emphasis of a matter paragraph, and there is a prior period adjustment footnote included at the back of the financial statements that kind of spells out what the effect of that change in accounting principle was this year. So, and lastly, we need to evaluate whether the district can continue to operate as a going concern, and there were no issues regarding that either. So we'll just go over our approach to the audit. We do a four-phased approach. Phase one, detailed planning, which is much less significant now that we're no longer in the first year of our audit contract. Phase two is more like a late spring or early summer, where we call it our interim phase, basically where we review the internal controls over systems and compliance where necessary. But we look at the district's significant transaction classes and the internal controls and the key controls over those transaction classes, and to see how and we look at how the design and implementation of those internal controls is operating. So every year we'll look at those, and we'll do it at a minimum, a walkthrough to verify that key controls that we identified in a prior year are still in place and operating. So the significant transaction classes that we identified for the district is financial reporting and budget control, the revenue cycle, which include billings, revenue recognition, and cash receipts, capital asset procurement and recording, the expense cycle, so purchasing, AP, and cash disbursements, payroll and related liabilities, which includes pension and OPEB, general IT controls as well. Phase three is the validation of account balances. That's what we do at year end. Give us the support for all your numbers in the TB. We're going to look at them. We're going to test certain things, compare to schedules, compare to what our expectations are for certain account balances, etc. And then phase four, which is where we are right now, which is the preparation and review of the financial statements and the issuance of our audit opinion. So last year we also will rotationally test internal controls over those significant significant transaction classes. Last year we tested the internal controls over utility billing, procurement, and the procurement and expenditure cycles. This year we focused the testing for internal controls on the revenue cycle and payroll, and then we also did test census data for pension and OPEB. All right, so here's the audit status and results. So phase one complete, phase two complete, phase three complete. We are, as I mentioned, in phase four. The report is in draft, and so we're still looking to include that introductory section and the MD&A and the stats. And then once we have those pieces in, we'll double check those against that information in those documents versus the information that's currently in the draft. And that will go through QC one more time, and we'll obviously have Wes and Jody take a look at that report too before we go final. So as far as our interim results, and this is something that essentially, we identified no significant deficiencies or material weaknesses in internal control over financial reporting. So if we did note some, it is required that we do communicate those, those to you, at least to management, if it's something that we just consider something kind of small. But if it rises to the level of a significant deficiency or a material weakness, then those would go in a formal report to the board. So we did not have any control deficiencies or other this year. All right, and then so for the year end, so again, I mentioned that we are issuing an unmodified opinion on the financial statements this year. And so what that means is that the financial statements are presented fairly. Again, in all material respects, the significant accounting policies have been consistently applied. The estimates used are reasonable, and the disclosures are properly reflected. As far as other results, we did not have any disagreements with management about accounting treatments or anything like that. And we noted no material weaknesses or significant deficiencies in internal controls over financial reporting, ones that would need to be that are required to be disclosed to the board. And then there were no accounting issues noted. And with that, that will conclude my my presentation.
Thank you, Coley.
Mhm.
Questions, comments?
I have a couple comments I'll add, but thank you, Coley, appreciate it. So he mentioned, we talked about the different versions of auditing, like the unmodified opinion. The way I like to think about that simply is the financial statements are management's responsibility or the district's responsibility. And basically they didn't modify what we gave them. So they looked at it and said, this is good. They didn't have to modify it. GASB 101, we went over that briefly. That was a major change this year. And just to give you more information on that, what that resulted in was additional expense for the district of about $1.2 million. The reason for that was we typically record what we have to pay out in cash for our compensated absences, and that would be either sick or vacation time. So when someone retires from the district, the balance of their sick is paid out 50% to the employee. So if you leave, you have options. You can either convert it to the PERS, and it's converted at 100% to PERS, or you can get paid out 50% in cash on your paycheck. So those are, or you could take a lot of sick time, right? So you could just be off for a long time. So those are kind of the options. In the past, since we were liable for 50% of the payout, that's what we would record. Now, GASB 101 says you can't do that anymore. You have to record the most likely scenario. And because we're only paying out 50%, a lot of people are saying, well, I'm going to send 100% to PERS, right? I'm going to send 100% to PERS, or I'm just going to take all that time off. I'm not going to waste 50, in essence, waste 50% of my time. So we looked at it, and the majority of the time, the people do one of those two things. They don't actually get it paid out. So based on that, we had to record the total liability instead of 50% of it. So that was an increase. The other part of it was we actually had to record tax implications of both the vacation and the sick expenditure accrual. I try not to use the big words, but accrual is just when you post an expense that hasn't happened yet. So we had to add tax to that, and that was the FICA tax, which is 7.65%. So that increased the liability by 7.65%. In effect, increasing the expense as well, which is why we had the $1.2 million increase. So from its increase this year, we had to also look back last year and say, okay, because we're presenting 2 years together, that's why I was mentioning a prior period adjustment. So we had to look at last year and say what was the additional expense from last year and put that on our financial statement.
Is that common? Like you mentioned, retroactive. Is that every year goes retroactive?
Well, whenever GASB does, they generally set the accounting principles for us. Whenever they put out, and they keep busy over there. They got 101 of them at least now. There may be more coming or more right now. So they seem to give us a new one almost every year. Whenever they put out one like this that has an impact on us, we show 2 years. So yeah, it'll result in a prior period adjustment if that's the case.
You never do it forward. You never, you're not.
You do it forward after that. So next year it's going to be incorporated.
Yeah, audit's always backwards. So
It's almost like we're reactive instead of proactive.
Yeah, with an audit, you're always looking at what actually happened. So we get to the end of the fiscal year in June, and then we actually don't start our audit until September. So we're always looking back on that anyway. In this case, we're looking back this year to June 30, 2025, and back to 2024.
Hence the purpose of an audit.
Is there a typical time of year that GASB issues a change like that, or does it just come whenever?
That'd be more of a question for Coley, because it seems like they're just always putting them out. And they're
Yeah.
like, and they just tell us 4 fiscal years ended, such and such a date, and different, entities have different, some may have October end dates or December end dates, but is there a typical time of year when GASB puts out their pronouncements, Coley?
No, not necessarily. I mean, if you look in the, in the footnote, we show what the upcoming ones are as well. And so at the beginning of those paragraphs, it'll say, in April 2020, 24, GASB issued this statement, or in September of 2023, GASB issued this statement. So it's really just kind of when they've had a chance to, to float the drafts and to receive comments and to go through that, go through that whole process. So yeah, there's not necessarily like, if we have to have them out by June 30, but usually when they come out, they're not going to be implemented for another couple of years, so they definitely still give you time to evaluate, what the impact is going to be on your financial statements for the, moving forward.
That's all I had, just a couple of comments.
Thank you for that, Cole, appreciate it.
Thanks,
Yeah,
Coley.
I want to thank both Jody and Wes, their job on our finance team. It's definitely shown through. And I think this is the second year, Jody, that you took the lead on it. I may be wrong about that. So
First year.
first year, so
She's been taking lead, she's been doing really well. This
Yeah.
year was almost as fully Jody, so
Yep.
it's 3 years.
great job.
Great year for me.
So a boring audit report is a good thing.
Boring
Yes.
audit report is an excellent thing.
It means we did our job well.
That's good, good job.
Thank you,
And
Coley.
it had no reflection on you, Cole. It was not boring, but I like the results of the
Oh
audit.
no, I love it when it's like you said, boring, when there's not, when the only things that I'm really reporting on is just kind of the, the standard and the required communications. There's no, fun stuff to go in there and report. That's better for all of us. So.
And like you said, it's a reflection on, Wes and Jody. Thank you. Okay, anything else?
Not bad.
This is both an investment and update policy review.
Yep, subject number 2, the investment update and policy review. As you know, I think it was 2022 or 3, we changed our investment advisors from, I won't mention the previous one, but we changed to GPA, Government Portfolio Advisors. They've been doing an excellent job, and our returns have increased significantly. And just to, put numbers to that, we went from something like 1.9 to almost $4 million last year in investment returns. That had to do with the economy as well as our excellent advisors. But this year, our results were actually up again by another 200,000. So from, I think it was 4.2 to 4.4 million in investment returns.
Nice.
They've got some excellent strategies and want to give us an update on the portfolio as well as the economic environment. So should be an interesting presentation. And we've got 3 AFMRs here today because I think the invite was forwarded to 2 different people. So they all have the same name, but if you could introduce yourselves so we have your actual names, I'd appreciate that. And welcome. So AMP is actually down on the left, right down there. And then we'll let the other ones do their introduction. So welcome.
Thank you very much, Wes and Finance Committee. I'm Deanne Woodring, President and Founder of Government Portfolio Advisors. So I'm the Senior Advisor on the portfolio. And Frank?
Hi, nice to see everyone. My name is Frank McDonald, and I am a client advisor, senior client advisor as well.
So it's nice to see all of you. So as Wes mentioned, we've been with you going on our 2nd year, and we've done a lot of structural and focus changes on the foundation of your portfolio for the long-term growth. And so I'm just going to give you a little background on the market economics, and then talk about the specifics of the portfolio and trying to see what we're seeing going forward for those earnings. As was mentioned, earnings were up this year. We're kind of flattening out on rates, and so it's really important the components and the structure of the portfolio to sustain and stabilize interest income going into the future. So first of all, let's talk about the markets. So the next slide. So when we started with you, you're using your, there's a liquidity component and there's an investment component. You use a couple of the funds there available in California that trade very similarly to the 3-month bill. So up here on the top slide here, we have where 3-month rates have gone from last year to this year. And you can see that they've declined significantly from a 4.62 September last year down to a 3.93. Those rates are totally exposed to what the Federal Reserve is doing. We're hearing a lot about the Fed moves. The Fed funds rate is the borrowing rate between banks. So it's their tool to increase pressure of borrowing or release pressure on borrowing and fuel the economy. So those are the investment horizons that we're kind of focused on and focused on change. And what we're looking at for the district's portfolio is how much do you need all the time overnight available, and then what amount is budgeted for longer term investments. So we try to really create a matching to your budget cycle and your needs to an investment side. So if you think about it as asset liability management, that's what we've built out and I think improved there at the district to create more foundation to the investment decision making. So if you look at the bottom part of this chart, you'll see kind of rates are jumping all over. There's a longer term maturity structure in here, the 10-year note, but we started with you right here when things were kind of all bunched together. The top line is that overnight 3-month bill rate, which is like your pool rate, and it's coming down dramatically. So we tried to lock down and anchor down more of your investable money so that you are not exposed to that continual decline that we continue to expect in the short-term environment. But as I mentioned, the more important part is matching the purpose of your money to how we're investing, and that's what we're doing, and you'll see that when we get into the slides of the portfolio. So that's kind of what's been happening in the market. I've been in these markets a long time, and this volatility is never predictable and never obvious, but we have come out of a very, very low rate environment. In today's rate environment, I don't think we're going to be approaching that 0%, hopefully anytime soon. For local governments, having this more 3.5% rate environment is so much more healthy for your income stream and the ongoing earnings of the portfolio. The next slide covers why it's changing. So we're focused on employment numbers and economic stability and growth. This is the Fed's agenda, and inflation. So right now we don't know where things are. With the government closure, the data's not there. But the trend lines in the market are still indicating that we're on a slow trend line downwards in front end rates, and they're able to adjust rates down mainly because of weaker employment numbers. So the Fed doesn't want to get us too stressed out and pushed into recessionary periods, and balancing, and that is their real magic. So we're focused on this dot plot up on the left-hand side that is looking out over the next 3 years of that slowly trend line coming down closer to 3%. From where we are today at 4%. So we focus on that as far as looking at the portfolio structure as well. And then let's roll into the portfolio. So you have a liquidity component. That liquidity component is made up of pooled investments. LAIF is the California investment pool. There's a San Diego pool. CAMP is a private total investment pool. All of them are managed around between a 3-month and a 6-month average maturity and result in those earnings that I showed you in that 3-month bill trend line. These are monies that you need to have available. You're subject to move with wherever rates are. You have an internal reserve of 17 million and a CIP requirement of 40 million. It's those numbers that are kind of constraining us from investing more. Wes has a good handle on what the CIP payments are and is tracking them. And we're going to watch to see if we can get a little more invested over this next year. But we don't want to overinvest because we don't want to be forced to sell something to come back to liquidity. So right now, in the terms that we're talking about are liquidity, which are in those investment vehicles. And then the core is a portfolio that has a horizon of about 2 years and an investment between 1 day and 5 years. And that's a real balanced portfolio that we are able to make a difference on in returns for the district's earnings funds in the long run. So the next slide, yep.
I'm mainly for Wes, I guess. So how far out are you looking for the CIP requirements? I mean, 2 years, 4 years?
No, liquidity usually I'll just take a look at the 1-year requirement, and we've got a little over $30 million budgeted this year just for CIP projects. So another thing we were talking about though is, we have the ratio of budgeted versus actual expenditures, and we've been getting closer to budget recently. So, but at the same time, I think the best we've done is like 80%. So while we've been maintaining, we have the operating reserves at 17 million, which is required for our reserve policy, but that's 6 months of operations. But then we have 30 million in CIP, and if we could potentially say, well, 80% of that, the 24 million or whatever it is what we were required plus the 17, instead of going with the full 30 to 40 of CIP, whatever before year. So it's usually 1 year to answer your question.
Mm,
1 year plus the operating reserves. So we have about $50 million or so liquid right now, and a little over, I think, 63 in investing.
That's just rolling.
Yeah, so they just, whenever the maturities, unless we tell them, hey, we need more for liquid purposes, then they reinvest it for us.
Okay. So the next slide kind of covers those successes that we had this year. We did intentionally add money to the core account back in mid 2024, where rates were slightly higher in that longer term positioning. And we were looking to add more, but you had pressure from that CIP that we were not able to do. So to me, that's a success because we really want these liquidity and core portfolios to work together and not to move too much one way or the other. So the timing of moving to that investment portfolio worked out well. We also were able to achieve and anchor down the earnings rates in that core account to 4.16. So the goal for your portfolio was to be able to lock in rates over a 2-year cycle of over 4%. So we're able to achieve that. That core balance yield will come down slower than that overnight yield that I represented. So that was the goal, is to put as much as we could in there and anchor it down. That was prudently balanced for the district. We also did some revisions on the investment policy that we felt were necessary right out of the chute, but we've got a pretty big deck coming your way to update to CDAC and California recommendations. Nothing is out of compliance, nothing is out of statute within the policy, but we kind of came on board and ran right to the policy, and we didn't have time to do a deep dive on that. So AMP's been working diligently on really getting some changes done, none of them material to the risk of the portfolio, but more alignment to best practices to make sure your policy is updated to those standards. And then we continue to manage for liquidity and uncertainty. As Wes just mentioned, there continues to be some uncertainty in the CIP. So as he gets that tightened down a little bit more internally there, then we can balance a little bit more out towards the core investments when available.
One more question. Sorry, I have a couple questions. So this is very interesting to me. So I know you mentioned there's quite a few investment policy updates and they're not solid yet. Is there a way you can just disclose maybe the top 1 or 2?
I have that at the end if we can wait for a minute. I actually have them bright big red circles for you. So we will touch on that
I can wait.
at the end. Okay, perfect. I like that when you're ready for it though. Okay, the next slide. This covers the actual portfolio policy that you currently have and how your positioning is overlaid to that. So each month your report provides you with this. We also have an online portal that provides Wes with this data every single day. So policy limits as structured on the left, and then where your actual portfolio resides. So right now you're in 27% treasuries and about 21% in agencies. And then we have about 35% or 40% to the liquidity accounts. So this just line by line gives you all the details of all the rules within your policy. And there's a lot of them in California, but we're able to track every single one. They get a little detailed when we get into ratings on credit, maturity structure. So we have everything in the system that ensures you at your oversight level that we are meeting your policy constraints. And we look at that prior to every trade that we do. The second part of it is
Those
the first part.
policy limits are like California, because we're a public agency?
Yes,
Gotcha.
statute code. Yeah, you have a code that you have to follow and you're limited by that. For example, the 5-year maturity is a policy code that we have to stay within and not exceed that. And that's also your policy. So maturity constrains us and types of securities are constrained by that policy. Okay, next slide. I'll go and go there. So this is the structure of the portfolio. So at the end of September, there was 68 million invested in the core investment portfolio. It had an average weighted maturity of about 2.1 years, and its yield was 4.16. You have an unrealized gain in the portfolio of about 600,000. That's just a reflection of price change that we bought those securities at a higher yield than they are marked today. We like to see positive gains, but really is just every day we're in the market, every day rates change, and we just make sure through our reporting and accountability to you that we're reflecting those changes. The liquidity component is made up of a combination of those assets that I mentioned, the camp and the lay funds, for a total portfolio size of about 113 million. And then you can see up in the top the asset allocation that we are using. Most of the assets that are allowable between commercial paper, corporate securities, supranational securities, treasuries, and agencies. So we want to make sure that the portfolio is diversified within types of securities as well as in maturity structure. And then the overall portfolio, when we add the investment component with your liquidity, into the quarter at 4.23 yield. So that's really a nice yield to end the period with, and we're holding above 4% right now. The total average maturity of the portfolio is about 1.3 years. So we're not long, and that's also constrained by statute and then maturity structure. So if we move money from the liquidity component to the core, your maturity would extend out. Next slide. And then we do try to trend out and look at inflows and outflows. These are the top bar chart is changes in balances. And this is where if we get a surprise or a higher pull out of cash, we're able to track what's happening in there. We don't have a real stable pattern. With a city or a county, you see pretty stable patterns. And this is just reflective of your CIP and what's happening within your projects there. And then your inflows are coming in September, April, May, so in the summer months. So that's just a little tracking of changes to the balances. And then if we go to September of 2025, your balances were at 109, and you're up a little bit here, same time this year at 113 million. Next slide. So in talking to Wes, when we were looking at the strategy, the expectation is for your overall balances probably to be declining. So we're prepared to be able to adjust that both through the liquidity and the core balances. Right now, we are targeting, we call it the GPA liquidity ratio, but we're keeping about 40% of your total assets in liquidity, and the remaining is staying in the investment core. As we mentioned, if you see that there's opportunities where we can reduce that liquidity a little bit, we will pull that to the core. But remember, we have maturities that are maturing every other month, so that we're always available. When we put it in the investment portfolio, there are always maturities coming off that we can pull the liquidity. So that's how we kind of keep a healthy portfolio structure by having these two portfolios work together. Next slide. So our recommendation was to really remain keeping that same balance right now. We will reinvest maturities when they occur, unless Wes says he needs it for liquidity. We are seeing your month-end balances reported to us every month. So we also will have a flag if you drop below 40 million. We know to just make a call out and see if we need that bond to go maturity. The bottom section here is showing that we have this ongoing maturity structure in that core account that works well with both reinvesting securities or if those need to get pulled over. So you have, not only do you have the 44 million in liquidity, we have 18 million in securities that are maturing under 1 year. And that's a reflection of the portfolio structure and how that's built. So I'll pause here for a minute with any questions that you may have. None? Okay. We also do in our reviews, we establish a minimum and maximum for each of those portfolio structures. So we're saying we want to get this portfolio, I need to correct that, to a minimum there of about 65 million and a maximum of 100. This keeps us from over investing any of these portfolios before having a discussion. And I do need to correct that core size to be a minimum of 65 million and a maximum of, we'll probably put 80 million so we don't overinvest there. Next slide. And then this is the policy review. This is how the portfolio is currently structured, your policy. The next page is going to be your update, so we can take a moment on that when we flip to that. So we're going in and we're really looking at the detail of the percentages that you're allowed to hold, and then also the wording within CDAC and code. CDAC is the California Debt and Investment Commission that oversees all policies within the state of California. The circles are us just kind of defining. So a perfect example is your certificates of deposit. In your current language, it just says certificates deposit, but there's two types. There's a negotiable and a non-negotiable. So we just want to call out and identify that. And then we're making recommendations to the overall percentage in the portfolio based off of risk in the portfolio and structure. So you'll get a long red line list and you'll get a summary of these changes that we're recommending when Wes is ready to pass that on to you, but it'll be in your box, Wes, in about 10 minutes. We have it ready to go. Or tomorrow morning. I have a car tomorrow. Tweaks. So when I mentioned too that we're not adding risk to the portfolio, you can see in the old one, 5 years was always your maximum maturity. We can't change that. That's code. Where we did change a little bit is we just added a couple of these areas that weren't defined in your current policy, or they were defined up in the wording of your policy, but they weren't in the table. So we're just doing some cleanup on aisle 9 on that type of thing. And we're open to any questions that you have. You can pass them through to Wes, and we can vet through those when you get those in your hands. And that is really it for our report. We're excited about the earnings and the positioning of the portfolio. There is one more section in that constraint table. We do recommend to add this maturity constraint that reviews the total portfolio together. So this would be new to your policy, and we have these in all of our standard policies. The under 30 days is making sure we're addressing your liquidity needs, which you are through those money market funds, but this just articulates it out into your policy.
Great job. Thank you. No, very informative. Questions? Discussion? Any?
So the investment policy goes to the board every year, and we always have red line changes in the staff report to say what we're changing. We may have a few more changes this year, but it'll be going probably next month. It can go up until December 31st. We have to put it to the board, so it'll be in the packet soon with the changes listed on the staff report.
You're going to review those recommendations and see where we go. Huh? Whatever Jody says.
Whatever Jody says.
Wes, is there an opportunity to tighten up the capital needs, or are we kind of on the end?
Well, you mean as far as our budgeting, or
as far as having more available to invest? If we tighten that, that 80%.
I think the best option there is going to be looking at the percentage spent historically, and then saying, okay, if we're between 60 and 80% instead of doing, and we're actually, I think we have $44 million total, so we're below it right now anyway. Right, so if we had, because I think our budget is at least $30 million total capital for this year, and we have 17 in operating reserve. So technically, we should probably be at $47 million in liquidity, and we're showing 44.
Yeah.
So we're a little bit below, but we might be able to say, okay, if we bump that down to 80 or 70%, would it be $5 million?
It's also got to self-correct by itself because we're in a construction phase right now, so there's significant amount of money going out, but then we'll be going into a design phase, and as you know, design costs significantly less than construction. So the capital outlay will be temporarily down for a few years until we get back into the next construction window, and then they'll be significantly up. And as the board committee members may remember from our budget presentations, we show our reserves going down, down, down. Obviously, we got some good news. So, as far as going out for any kind of debt service, it may get pushed off a little bit longer, I'm hoping. But at the end of the day, we'll see kind of ebb and flow. This year, we're not going to hit the 80%, but we've also been short-staffed in engineering, which has slowed project completion down. However, big construction projects like the one that the board's been invited to tour, those are significant expenditures, and they're now underway, but they took because of still from lingering effects of COVID issues. It took us almost 2 years just to get electrical equipment to our pump stations.
Determining the timing is always a challenge.
Mm-hmm.
Well, and it's also important to note that, and probably the most important, that we're not really being affected by it yet. So camp is still high enough, so it's meeting the 3 month and it's doing pretty well. If the Fed starts lowering rates and camp starts to decline big time, we're not locked in. So, and correct me if I'm wrong, Deanne, but I don't think we're really being affected too much by that, maybe because we're still getting those good returns in camp. Now, if there's some sort of If Dan said, oh, I think it's gonna start coming down, we really should get out a little bit longer
Or
term,
terrific, relocated.
then we'll stress it a little more. So right now, it's not like a, a big stressor for us, but it could be in the future, and that's when we really try to tighten up as much as we could.
And that's a really good point. It's definitely not hurting you to hold that excess liquidity right now because of a yield curve inversion. And we were just looking at the forward rates on the market, and we don't really see that 2-year getting away from us, dropping much below 3.5 right now. That's what the markets, I read the cards of the markets. So when we see that front end come down, then we can just gradually make another decision to move over. But right now, as far as rates, we're fine. If rates went to 2% on 2 years, we would have missed it. But we don't feel like that risk is out there right now, but we are keeping Wes apprised of that.
And a big tableau on my side, you mentioned before, a couple of meetings ago, issuing debt, no need in the near future that you're.
We've done well planning financially, so we look like we're pretty healthy. Our budget shows the potential need for it in 2028, I believe you said. I think it's 2028, and that's going to be in the sewer fund, I believe, as well. So, the longer we can stretch out, the better, because that's not cheap right now. So,
And correct me if I'm wrong, I know currently all of our debt doesn't hit our ratepayers because it all goes to our expansion fund. So developer driven CIPs basically, or developer components of the CIPs at least. And our next debt issuance, if we have one, that's also for expansion, or is that both cover operational and expansion?
there was one that's in there for possibly, because I think there was like a little bit of water and some sewer. I'm trying to remember exactly. It's around the same time, 27, 28, right around there. And it was only, I think it was less than $15 million in the budget forecast. Now, if we are under in our CIP and it gets postponed even further, then I could see that $15 million not need to happen. And we'll try to do everything we can to not issue it if it's not advantageous to us.
Without predicting the future, that's kind of where we see things are going. We're going to be in the closer to the 60 percentile range in the CIP due to staffing and delays in construction on the projects. And then we've had some favorable variances in our budgeting and also investments that also reduce the need for going out for debt service most likely in 28. So it'll get pushed out. Next year's budget will probably be our first real opportunity to take a look at where we land.
Well, thank you. Keep investing well so we don't have to issue debt.
Okay, we'll stay on it.
Thank you.
Thanks.
Thank you.
Thanks, everybody.
Thank you.
Any other comments, questions? Anyone? Okay. And with that, all right. One last question now. So how are they paid like on a, how are they paid?
Per balance of the portfolio. So they have a vested interest in us increasing
Okay,
the amount that we give to them. So
More money they manage, more money they make, the more money they get.
Sounds like a commercial.
I understand commissions.
So I keep that in mind as, when they're recommending balance increases, part of me says, okay, but they've been really good at saying, like you heard her say, she's not seeing the top end of the curve come down on the 2-year. So right now there's no stresses. They haven't been pressuring, they haven't been saying, hey, you really should. While they have said, hey, we'd really like to get more money in there, I'm like, I knew you would.
Yeah, of course. Was our previous investment advisor the same?
Yes.
Oh, they're all paid
But they were much more expensive.
Yeah, they're
double the cost.
double the cost for
On a percentage basis?
They were double the cost.
Chandler.
Chandler.
Yeah.
And Chandler's a kind of a big dog. They do big
Yeah,
agencies. So
I think it's still good.
They didn't give us any attention. They really just kind of did the month-to-month thing. And
It's too bad.
Wow.
But one of the things I want to point out, I mean, granted, this is Monday morning quarterbacking, but when GPA first came on board, they said, hey, there's 2-year notes and so on and so forth, and 5 years that we can give them at 4%. So we should lock these in. And there's some trepidation with the board because some of the money that in the short term was, edging close to 5%. So why would you lock in something at 4% or 4.5% when there's 5% money out there right now? And they came on board and presented to the board and said, this is the time. You almost never saw this. I remember they showed a graph of these notes, that are available for government agencies, and hitting this percentages is pretty rare. And we ended up, listening to them moving money over. And that's even though we took a lot of money out of short term, the LAIF and the camp, we actually end up making more money with their strategy by a few $100,000. And not only that, it locked us in to guarantee that yield for a couple of years. And so we're not riding the train going downhill necessarily
It's
fully.
actually the other way around,
Yeah.
So, and I wanted to mention that too, and you actually didn't, but if you looked at the book yield versus the market yield on our report, it's changed now, it's flipped over. So it used to be that our book yield was like 1.5% and the market yield might have been 3.6. And then, I don't know if you remember Director Grosset, you're like, well, why can't we just sell it all and get that 3.6?
Yeah.
And we had to explain that because we lose all the money first and then you'd be investing and getting the 3.6, but the losses would cause you to get the 1.5 anyway. So it zeroes itself out. So without going into too much on that, we actually now the market yield is 3.99 and our book yield is 4.19. So we've now flipped the
I
table
like
and
the tune of that a lot better.
we've invested a little bit longer term and now we're getting that longer term benefit from it. And we're actually beating the market right now. So
Good, so we're on a good path.
we are,
With
we're
your
doing
company.
well and the returns are, increasing and it's looking good.
Well, thank you both. Thank you. Any other comments? If not, this meeting is adjourned. Thank you.